Good morning, everybody. My name is Carrie Hamaker. I'm the single family administrator here at Alabama Housing Finance Authority, and I'm very excited to be with you today to talk about this new program that we're launching. It's a new old program, but we've made some updates to it, and I think that you'll find that it's going to be a really good product for you to be able to offer to your home buyers out there, whether you're a real estate agent or a lender. So on today's agenda, our discussion points are going to be the First Step program overview, how the First Step program works, First Step origination process, going over what is recapture, First Step reservation process, which is how you lock the loan, the forms, which you've got a copy of all of that information there, and then open discussion where you'll be able to ask questions. So the First Step program is a mortgage revenue bond program. Nearly 50,000 Alabama households have benefited from AHFA's First Step program, which offers below market 30-year fixed rate mortgage interest rates to first-time or repeat home buyers. This program it wasn't called First Step at the time, of course, but when it first came out was 1982, I believe, was the first mortgage revenue bond program that was issued by AHFA. And at the time when bond loans first started to come out in the 80s, interest rates were really high. I probably don't have to tell a lot of you that. A program that was, come together with legislators and the IRS to be able to make interest rates lower to help folks who are of a low to moderate income become homeowners was hugely needed at the time. And we find ourselves now back in a raising interest rate environment. And with obviously inflation also coming into play, a lot of folks are really feeling stretched to be able to afford a home with today's interest rates. So we felt like it was time to bring the program back out. The last time we had First Step here in Alabama was in 2012. And so we're excited that it's available again. And we've made some updates to the program through guidance from the updated guidance through the IRS that modernizes it and I think makes it a lot more easy to use. So the loan types, term, and rate. The loan types are the FHA 203B and 234C, so that's your regular FHA forward mortgage program, and the 234C is your condo project. VA loans, the guaranteed loan program, Freddie Mac, HFA Advantage, and we're adding USDA to this mix. All of those can be done at their full 100% or 96.5%. So FHA is 96.5%, Freddie Mac's 97%, and of course on VA and USDA you're able to go up to 100%. You can use our down payment assistance in addition to help pay borrower closing costs, and if now with the recent change with real estate commissions where buyers have to pay their own or need to pay their own, if the seller is not covering for that and borrower paid costs, then you could use a portion of that down payment assistance to cover those costs. The loan terms, our first mortgage is 30 years and the second mortgage is a 10-year term DPA. The interest rate will be set by AHFA. Both the first and the second mortgages are at the same rate. So this works exactly like Step Up in many ways. So if you think about it, I used the analogy yesterday and I think it works pretty good. This is like a layer cake. So the first layer of the cake is going to be your regular mortgage program, whatever is actually the terms of that loan and how it's underwritten for repayment purposes and who the guarantee is being given by. So for FHA, that's a traditional FHA loan. Your credit underwriter at your shop is going to underwrite it just like your regular FHA loan and follow those guidelines. VA, again, is going to be underwritten just like a regular VA loan. The Freddie Mac HFA Advantage is underwritten as a Freddie Mac, and then USDA. You're still going to have to meet all the requirements of that USDA loan. So on this particular program, if you think about it, you've got USDA's guidelines and their income limits for its program and their locations that you're eligible for a USDA loan. You'll still have to go meet all of those requirements and get USDA to issue their conditional commitment. Then you have the next layer, which is the MRB piece, which is what are the requirements that the IRS puts in place for this particular type of loan. And then you have the top, which is AHFA. Are there any additional AHFA overlays that we would incorporate in that? So if we think about Step Up, what are those? 640 credit score, 45% debt to income ratio. So those would still apply. Before we get into eligible loan areas, I do want to lay a little bit of foundation, a little bit more foundation on the First Step program. So we are allocated bond cap by the state to make this type of program available. The state, we went to them. Jimmy McLemore, who's our general counsel back there, he went to them, so he fought the hard fight for us. He went to the state and laid it out on the table, the kind of obstacles that are in place right now for a lot of low to moderate home buyers in the state. They're facing high interest rates, still high sales prices, and a low inventory. And what could be done by the state to help facilitate, giving people a break, basically. And bond cap was a way to do that by offering a mortgage revenue bond program. And they did set aside a significant amount of bond cap that we have 3 years to be able to expend. And we're going to do that in incremental ways. And so the first allocation, so there'll be series that come out for this particular program. But the first allocation that we're going to do is $35 million. So there is a pool of money of $35 million. And every time you have a home buyer who applies for a loan and you go out and reserve it or lock it and you pull that money down, that money is no longer available within that $35 million. And so we're drawing that money down, okay? Every loan by loan. It's real important as you go out and reserve loans, if you find out that that borrower is going to need to cancel that reservation for any reason, they're not going to be able to get the loan, whatever it may be, the deal falls through, then it's real important that you all notify us as soon as you're aware so that we can free that money back up into that pot of available funds so that another homeowner can utilize it. There is a commitment fee just like there is on step up. It's the same factors that you use. That commitment fee is fully refundable to the home buyer if they do not close on the loan. You do have to notify us within 30 days of canceling the reservation or 30 days of the reservation expiration date, okay? The cancellation needs to, and the request for refund needs to come from, the cancellation can come from you, but in that email, you'll need to include either a letter or an email from the home buyer requesting that they get a refund of that reservation fee. If you don't do it within 30 days of those two, either you notifying us to cancel it or it expiring, then we won't be able to issue that refund because there are accounting things that are happening, and that money gets in different places. So we need it within 30 days. That's also applicable to step up now. So commitment fee is refundable if the loan falls through. Now, if you email us and tell us that the borrower decided they got a better interest rate with so-and-so or this type of program, that's going to be a mark against y'all, because what we can't be doing is taking money and putting it up in this place where nobody else can get to it, and then you've got a bunch of loans falling out. Eligible loan areas. So the entire state of Alabama is an eligible loan area. Federal law requires that we at AHFA set aside at least 20% of the allocation for targeted areas of the state for a period of at least 12 months. We're going to be tracking that here at AHFA. That's not something you all need to concern yourself with. We've got a lot of targeted areas here in the state of Alabama, so we should be able to meet that requirement no problem at all. AHFA will monitor the use of those targeted funds. What are targeted areas? A targeted area is a qualified census tract or an area identified previously as economically distressed. A targeted area may be the entire county or may be a particular census tract or other designated specific area within that county. Other counties may be all non-targeted. Some targeted area determinations can be validated via the following website. We actually have a link to the Policy Map website that will take you where you can look up the property, which I'll show you what that looks like here. That actually, if you go to our website, you go to ahfa.com, you go to lenders, and you look at programs available, and you click on First Step, there's a link to this map where you can look up what is a target and non-target. You put the property address right up at the top. You've probably used maps like this in other types of things. You put the property address up at the top, and it's going to zoom down in to where that property is. And it's going to tell you one of three things. Either, number one, it's in a county that is not targeted. You can see the counties here that are in gray. There are no targeted areas within those counties. The ones that are green, that entire county is a targeted area. And the ones that are orange, there are some census tracts, cities that are target areas, and there are some non-target areas within those counties. And you need to send this document here, which is our target area ID status request form, to us, and we'll let you know if that will authenticate for you whether or not and validate whether it is in a targeted census tract or is not. If you send that to us at compliance@ahfa.com during business hours, we'll respond to you within 2 hours and let you know if it is or is not in a targeted area. We will be updating that map as we are able to include more and more of those targeted areas, so you'll get more and more validation right off the bat, but that is a process that takes some time. So you would send that form in and we'll let you know. The good thing about this form is you can send it in at any time. So if you're a realtor and you are listing a property and you want to be able to put in the comments that it is eligible for the Mortgage Revenue Bond Program as a targeted property in a targeted area, send this in and we'll let you know. If you're a buyer's agent and you want to be able to tell that borrower whether or not they could get this bond loan program, send this in and we'll let you know. Lenders, send it in before you've reserved the loan. Just because obviously how you're going to pre-qualify them is going to be based on the targeted or non-targeted areas. And it can make a difference. It doesn't change the interest rate for the program, but it sure does make a difference whether they have to be a first-time home buyer or not. So targeted areas, we're going to just kind of go through the definition of this and what the differences are. In a targeted area, there is a higher income limit. There are higher sales price and acquisition limits, and there's no first-time home buyer restriction. In a non-targeted area, it's lower income limits, lower sales price and acquisition limits, and the borrower must be a first-time home buyer. The IRS defines being a first-time home buyer as not owning a property, not having an ownership interest in a primary residence for the last 3 years based on the date of application. So I had a question from a lender right before we started doing our trainings, and they asked, well, on May 5th, the 3-year term will be up for them. And I said, well, you can't have an application dated before May 5th then. That's when that date will be. So we're going to talk about property eligibility, prohibited property uses, eligible property uses, property improvements, excess land usage, and title restrictions. So prohibited property uses. The property cannot be rented, leased, quitclaimed, assigned, or interest transferred. That's for the life of the loan. The property cannot be used as a place of business or trade. The mortgagor cannot deduct any portion of their residence as a home business. One thing to keep in mind on this, a question that may come up as we do the compliance underwriting on it and looking at whether or not they are eligible for the MRB part of the cake, is if we get over the tax transcript and we see that they're taking a deduction for business use of home, we're going to ask, are they going to continue to utilize this new property to run their business? Because if so, they're not eligible for this MRB program. So if we have, let's say, a person who has been running a hair salon out of their current home, and so they're using business use of home, we would have to be able to have that borrower give us an affidavit or otherwise validate that they are no longer going to be doing that in the new home. An example of that would be from an MCC that we did recently. The home buyer provided something showing that they were now going to lease a booth at a hair salon, so they were no longer going to be an at-home hairstylist. So that's fine. If they are selling Mary Kay or any of those types of things where they're setting aside a portion of that, they would need to give us an affidavit stating that they're no longer going to do that. Okay? They can still do the Mary Kay. What they can't do is use a deduction on their tax return that shows that they use that home for business. The property cannot be used as an investment property, so they cannot rent any space within that home or any of, like if they're buying a house and it's got an outbuilding or a pasture or something like that, they couldn't be going and renting out a portion of that. That would be called, no income production can happen on that property. The property cannot be used as recreational, seasonal, vacation, or as a second home. So that's kind of self-explanatory. They've got to live in it. Qualified residence and property requirements. No leasehold properties. It's got to be a fee simple property. 1 unit single family detached. 1 unit row house or townhome. Approved FHA, VA, or Freddie Mac condo projects. Manufactured homes classified as real property for our government loans only, so that means it has to actually be assessed by the tax assessor as real property. The house has to be on a permanent foundation, and they can't have a separate title for the mobile home. That'll have to be quit. Property improvements. During the first year of ownership, the mortgagor cannot make improvements or have services performed that would cause the acquisition cost to exceed the maximum sales price limit. And we'll get to what those limits are soon, but I kind of want to explain this a little bit. Ineligible improvements would be the addition of fixtures, completion of livable basement or attic space, addition of rooms or outbuildings. So let's go back in time again, like I was talking about earlier in the 80s, where interest rates were really high. There was a limited amount of bond dollars available, because like I said, it's an allocation, so it's first come, first serve. When it's gone, it's gone. There were a lot of builders out there were building new construction homes, and their sales price was going to be right at that acquisition limit. So what they were going to do was not finish portions of the house and have a side contract with that buyer to finish it after the fact, so that that acquisition cost stayed under the limit to be able to take advantage of that lower rate. So that's one of the reasons why the IRS put that in place. So, but some examples of how that could be relative now to us is if you have a buyer buying a home and it's got, we don't so much in Montgomery have unfinished basements, but in other parts of the state they do, or let's say there's unfinished second floor space that's right now just kind of an attic space, but they could finish it off to a loft or something like that. That's fine, they can do that, but if that buyer within the next 12 months has plans to finish that space, we would have to get the quote of what that's going to cost to finish it and add that to the acquisition cost so that we could figure out the right limit. If you had a buyer who was buying a property and it had, let's say it was a house and 10 acres, and they were doing an FHA loan, and the FHA appraiser said, well, that's excess land. They can't have the whole 10 acres. They've got to buy that other 5 acres separate. We're going to cut it down to 5. That's okay, but again, we would have to get what the amount that they're paying for that additional acreage that's part of the whole purchase transaction, add the sales price of the house plus the sales price of that acreage, and add it all together to get to our true acquisition cost. Another example would be, used to not see this, but we're seeing it some more and more, where the home inspection or the appraisal come back and there's repairs that need to be made to the property. And the seller says, I'm not making them. And the buyer agrees to go ahead and pay to make those repairs. We would take the cost of what those repairs are, because they're not financed into the loan, and we would add them, and they're not part of the sales price, so we would add those to the acquisition cost. Once you see the worksheet that we would have, that you figure the income and the acquisition cost on, it's pretty easy. Excess land and land usage. Land being purchased with the resident should maintain the basic livability of the residence and cannot provide a source of income to the eligible mortgagor. If the land is capable of being subdivided or used in an agricultural business, the borrower must certify that they will not subdivide or otherwise sell any real property on which the resident is or is to be located, except in conjunction with the future sale of the residence. So again, we'll take a house and 10 acres. They can't subdivide it during the life of the loan and sell that other 5 acres off. They would have to sell all of it together. Seek any variance from applicable zoning, minimum lot size, or setback requirements, and start a homestead business on their property. So in a nutshell, MRB overlays do not have anything, that layer of the cake doesn't have any restriction on the size of the lot at all. They could have 20 acres, but you do still have that base layer, which is your agency requirements. So if your agency guidelines don't meet that, if they do have acreage limits, then those do still apply. There is a disclosure. A lot of these things that I'm going to talk about where the borrower has to certify that they will not make any improvements, that they're not going to sell out that property, that they're not going to generate any income, that's all encapsulated in a disclosure that we're going to make available to the lenders to include in their application package. So it's not like you're having to go write out a bunch of separate affidavits. These are all in this one document. Title restrictions. Title may be held only in the names of those persons who both sign the mortgage note and the security instrument. The warranty deed must be prepared correctly to ensure it adheres to these program requirements. Property still within a remaining redemption period from foreclosure may not have a title exception for the redemption period. They can get a redemption bond, that's fine, but you can't just have an exception without a bond. So let's talk about who can be on title, okay? This is kind of a big deal. And you're gonna find out why, and we had to pick a trade-off here. And I think we picked the right trade. But this means only those who are on the loan. So if you have a married couple and one of the parties is not gonna be on the loan, they cannot hold title. Only borrowers. Now, if we get a sales contract over and it's got 2 people on the sales contract as the purchasers, but there's only one on the loan, We're not going to come back and make you change the sales contract and strike sales contract. But what we are going to do is remind you, just remember when you order your title, not to have that deed prepared with that other non-borrowing spouse or person on there. Okay. Borrower eligibility. First-time home buyer requirement, household size, income limits, income documentation, sales price limits, acquisition cost, and credit overlays. I want to go back a little bit before I forget it, because it keeps bugging me that I left it off when I was talking about that $35 million that we have available. It is our intention to continue to issue new series because we have a lot of bond cap to go through in the next several years. We set it at $35 million because the interest rate market right now has been somewhat volatile, going up a little bit, going down a little bit. And you never can tell exactly what it's going to do. And I don't think anyone, even the Fed, doesn't know what they're going to do. So none of us know. That being the case, what we didn't want to do, because the way that the rate is set is it's got to, the whole program is let's get a mortgage rate below market. Well, if market keeps moving and we have this balloon of money that we've set aside at a particular interest rate because we're selling it and getting rate, I've tied down that $35 million at a specific rate. So if rates go down on the market, well, then there's not as big of a gap between our MRB program and the regular market. We didn't want to do that. So we're doing relatively small issues, but we plan on, as soon as we put this issue out and you all start originating and putting borrowers into this, getting ready to do another one. And then, so that way we're staying current with where the market's at. Because there are states out there that do 100 or even more $1 million at a time, and then slowly but surely their rate may not look as good depending on what's going on. So borrower eligibility. First-time home buyers, you must be a first-time home buyer if the borrower is buying a property that is in a non-targeted area. We talked about no ownership interest in the principal residence in 3 years prior to the execution of the application. That's considered a first-time home buyer. There is an exemption to that first-time home buyer requirement. That is, veterans and their spouses are exempt from the 3-year ownership rule as long as the veteran has not financed a home using an MRB loan and he or she was not dishonorably discharged. And in our application package disclosures, we'll show you those. But veterans basically can buy anywhere in the state as long as they're eligible. They've been honorably discharged or they are currently enrolled in the military. Then they would be able to use this program and not have to be a first-time home buyer. They still have to meet the income requirements based on whether it's targeted or non-targeted, but they get an exemption for the requirement of being a first-time home buyer. Ownership interest includes fee simple, joint tenancy, interest of a tenant shareholder in a cooperative, life estates, ownership of a manufactured home on owned or land lease for 3+ years. So if you've got a borrower who currently owns a chattel manufactured home and they've been on a lot that they're leasing, if they've leased that lot for less than 3 years, then they're not considered a current homeowner. If they've been leasing that lot for 3 or more years, they are considered a current homeowner. Or if they own the lot that manufactured home sits on. If they, let's say this happens a lot now lately, if they are listed on the deed of a family member's home, like their parents or their grandparents or something like that, if we can document that they have not occupied that property as their primary residence, then they are still considered a first-time home buyer. If they owned a home previously, let's say they relocated from Tennessee to Alabama and they did that 4 years ago, and that their home that they own from Tennessee, they use it as a rental property. They just kept it as a rental property, but they've been renting while they're here in Alabama. They don't own a home, and now they're ready to buy one. They would be considered a first-time home buyer as long as they have not occupied that home within the last 3 years. So it doesn't mean you can't own anything, it just means you can't have lived on that property. How do we document the first-time home buyer eligibility? They sign the affidavit, which I talked about, and we'll go over that form when we talk about the forms. The 1003, obviously we're going to look at the 1003 and see if they owned a home in the last 3 years. The tri-merge credit report, we're going to look at the credit report and see is there any mortgages that were either currently open or that were paid off in the last 3 years. Copy of the drive report, fraud guard report, or MERS report. Most of the lenders are utilizing those in their operations to validate a whole bunch of things, but prior home ownership is going to be on there as well. Only required if the borrower is purchasing in a non-targeted area. So if they're in a non-targeted area, you need to validate whether they're a first-time home buyer or not. If they're buying in a target area, it doesn't matter because they don't have to be a first-time home buyer. And it says additional documentation may be required. Again, like talking about the instance where they are on the deed with their mom's house, but they never lived there. So we would go through some extra steps on how do we document that. If you come up against that, what you're going to do is call Tony, and he's going to walk you through what are some additional documents that we would accept to be able to clear that. Household size. Income and sales price limits are based on household size. Any changes to the total household could affect the borrower's eligibility and may require additional documentation. We do not allow on this program any non-occupant co-borrowers or co-signers. So, parents can't sign with their child, anything like that, and not live in the property. Anyone who's a borrower has to occupy it. Unborn children are excluded from household size. There's a document in here again we'll go over where they're going to list everyone that's going to live in the home that they anticipate is going to live in it so that we know we're using the right income limit for that particular household size. Credit overlays. So this is the top of that layer cake I was talking about. This is what AHFA's requirements are for just any loan that we do. We do require a minimum credit score of 640, same as with Step Up. You don't have to have 3 scores, but they have to have at least 1 score and it's got to be at least 640. Maximum debt to income is 45%. No manually underwritten loans unless they are downgrading an approve eligible or an accept LPA manually because the FHA guidelines or VA guidelines required that they do that. As long as the findings still say approve, we're good. Automated underwriting finding requirements. So on FHA VA loans, you can use either Freddie Mac's LPA or Fannie Mae's DU. On the Freddie Mac HFA Advantage, you must run their LPA and get an accept. And USDA, you're going to run USDA GUS and get an accept. Income limits and income documentation. These are available on our website, same place that I pointed to when we talked about the targeted area maps. These do change from time to time, so I would encourage you to look at them. Now, when we change them, we'll make announcements, but still it always is good to check them from time to time so that you know you're using the right income limits. So if we were to talk about Montgomery, there are these areas that are individually pointed out, specific areas and counties within those areas, and then there's a statewide limit. So Montgomery is not designated as its own separate income limit. So here in Montgomery, we would use the general statewide limits. And so for a household of 3 in a targeted area, it would be $111,440 would be the income limit. In a non-targeted area, it would be $91,540. So that's why we need to make sure we know how many people are going to live in this house. First step income eligibility versus qualifying income. The lender will complete the first step income calculation, eligibility, and credit qualifying income calculation. So the key word here is initial. When we talk about first step income, you are initially going to pre-qualify them for the MRB portion of the loan and say this meets the requirements and it's within those 2 brackets. We will do the final approval on that income, that layer of the cake. We're going to do that here at AHFA, Tony's group. We've actually hired additional staff to be able to cover this. They've got underwriting background, like real underwriter background, and so they are very qualified and great to work with. So they'll be doing that portion for y'all and issuing a conditional commitment, much like USDA does. So we'll be issuing the approval and signing off that we verified that they are eligible for this program for income and area, and then also acquisition cost. Prior to closing, AHFA will review and approve the borrower's first step income eligibility and issue the conditional commitment. There is an income calculation worksheet that we will provide to you all. It's a very easy to use form and we'll be showing what that looks like here in another slide. We will use all sources of income, so your underwriter may not be able to use some income that's newly received or only periodically received, where we would. An example of that is going to be child support. Let's talk about child support. If you've got a buyer and they're divorced and the children are living in the home and you're validating whether or not they are receiving child support, your underwriter is already going to be asking that question because they need to know, do they owe child support? And it says on their divorce decree that they are going to get $500 a month in child support. Well, for USDA, you just have to use the $500 a month as income. For us, you would document how much they've actually received, and we would annualize that. So if in the last 12 months they've only received $500, we would take 500 divided by 12 and project that forward, so that as the monthly amount is much less. Your underwriter for your agency program isn't going to be able to count anything at all because they don't receive it regularly, right? So those are the kind of different layers of the cake where we've got to really think about what it is we're doing here. If the borrower is not working and does not plan to seek employment within the next 12 months, an employment statement is required. That document is in this packet. We'll talk about it. But it does say, I'm currently unemployed and I have no plans to seek work within the next 12 months. Income of household members not on the loan is not included in the First Step program income eligibility calculation. So that's big. Again, we're taking the same married couple. One spouse is not going to be on the loan. Even if they work, we do not include their income in our income eligibility requirement. So we're only counting whoever's on the loan. Grandma lives in the house. We don't go and get grandma's social security statements to have to include her income. We've got a spouse who the heck knows where they are. We don't have to go try to find them and document their income and all of that kind of stuff. So there's no more having to ask y'all to really infringe upon people's lives and get a whole bunch of extra documentation. That is why only those who are on the loan can hold title. If we were to let everybody, anybody that wanted to hold title be on the loan, then we're having to document everybody in that house's income. And it just makes it a lot more cumbersome, and I think it's going to cause a lot of people not to be eligible that should be. Yeah, ours would be 12 months. So if they're not going to continue to receive it for the next 12 months, then we wouldn't count it. If it is going to still be received for the next, 12 months or more, then we would. Yeah. What is included in the First Step income calculation? Obviously, their W-2 and 1099 income, overtime, bonuses, fees, tips, second jobs, dividend and interest income, alimony and child support, VA benefits, disability income, unemployment benefits, and Social Security income, net rental income, self-employed income from the Schedule C, E, or F on their Form 1040, and partnership income, etc. So all their self-employed income. What is not included is food stamps, foster care income or adoption assistance payments, earned income tax credit, income from a live-in aid, student financial assistance paid to the school, one-time withdrawal from retirement and investment accounts within a 12-month period, medical reimbursement, and military hazard duty pay. There may be other sources of income that we also wouldn't include. On the live-in aid, I think just to kind of explain what that is, if they've got an elderly or disabled person that's going to live in the home and they receive a stipend through Social Security or something like that to take care of that person, that we would not include that in their income. Required documentation. There, like I talked about before, there is a worksheet that you all will complete. It doesn't matter who completes it, just someone on your side showing how you calculated the income to pre-qualify them for eligibility. And then we'll fill out one on our side as well and make sure that they either match or if they don't match, we'll get back with y'all and let you know what the difference was, just so that we can all get on the same page and do income the same way. Most recent 30-day consecutive pay stubs from the date of initial application. The pay stubs must include year-to-date earnings. If they don't, then we're going to have to get a full VOE because we've got to know what their year-to-date total earnings are. W-2s for the most recent year and the most recent year's tax transcript. Again, talking about the layers on the cake, the IRS considers February 15th as the cutoff date for the most recent year, even though you don't have to file your returns till the 15th. We do have to have them as of February 15th. So right now, if you're originating a loan for this program, you would need their 2023 tax transcript and 1099s. Current award letters for applicable other income sources such as divorce decree, separation agreement, or other verification of child support or alimony payments received. Self-employed borrowers, the most recent year federal tax transcript and assigned and dated year-to-date P&L. Rental income, if applicable, documented with the lease agreement or third-party verification of market rent, and 75% of that will be used as annual income. For any retained property, rental income will be estimated unless the borrower provides a statement that they have no intention to rent that property within the 12 months. So let's use an example. We have no restrictions on them retaining so if they're buying in a target area, so they're not a first-time home buyer, and they're going to retain the current home that they live in, that they own, and they intend to rent it. There's a couple different ways we can validate what that rental income is going to be. They've already got a lease in place. You would provide us a copy of the lease. If it says they're going to rent it for $800 a month, we're going to take 75% of that and count it towards their monthly income. If they don't have a lease yet, you can validate it by going to Zillow and seeing what Zillow estimates the market rent will be, and then we'll use 75% of that monthly amount. Or you can get a broker price opinion or a appraisal market rent schedule that will tell you what the estimated rents will be. Again, we're just using 75%. That's even if they, we're talking about somebody, we'll talk about the military person that owns another property. If they've had a lease on it for several years, we can just take that lease, or we can do the Zillow or the appraisal or the broker price opinion. So again, we aren't going to take their tax returns for 3 years or 2 years and do a whole cash flow and all that other stuff. We just don't do that. It's much easier to do this, and the IRS lets us, so we're going to take it. First step, income eligibility calculation. Gross income is calculated by projecting gross income forward for the 12-month period beginning on the date of loan application. Year-to-date earnings reported on the pay stub should be reviewed by the lender to determine if more income has been earned than base earnings. Any non-recurring income should be verified with the employer before deducting it from eligibility income. So an example of that would be if you've got a borrower who you can look at last year's same job, right, same employer. You look at last year's W-2 and you look at their year-to-date and you see a lot more income on their year-to-date than was on the W-2. Then you're going to start asking questions. Well, did you get a raise? Why is this more income? Well, we've been working a lot of overtime these last few months, and last year I didn't get that much overtime. So then I would ask, okay, well, why was that? Well, we've had a lot of people that quit. I work at Dollar General, and you never know when somebody's going to show up or not, and so now I got to work all these hours. Okay, well, can we get something from that employer that's going to validate that this is just a situational thing? I'm not going to be guaranteed this. I don't know that I'm going to continue to make it, all of that type of stuff. Or let's say somebody gets a bonus from their employer for referring a new employee and they get a $250 bonus. It's a one-time thing. If we can document that with the employer, then we don't have to count that $250 because they're probably not going to make it again, or at least there's no guarantee that they will. Or in the situation of the guy that works at Dollar General, you probably can't get anything from that employer because all they're going to tell you is go to the work number. So what you could do is take their year-to-date, their prior year's overtime, and so last year would be a full 12 months, this year would be 3 months, and add those two numbers together, divide it over that period of time, so 12 plus 3, and then that's a monthly amount, and then project that forward for 12. Does that make sense? It's very simple, very easy. Typically, income from overtime, bonuses, and commissions will be average for prior year and year-to-date. So just what I was talking about. Unless for some reason we know that it's more now than it was. So let's say last year at their employer, their W-2 reflects just base pay. I can tell by looking at it, it's just base pay. But now I see there's a commission on their pay stub, or there's a bonus on their pay stub. I'm going to ask the question, is this something that you're expecting to reoccur? Well, yeah, I got a promotion and now I get bonuses. Okay, then we're going to take that year-to-date amount that they've earned and we're going to project it forward. So we're going to divide it by just the number of months that are in that year. This program is really looking at who that person is today, right? And what they've been earning over the last 12 months and trying to project for the next year, are they going to meet the program requirement? Any income used for credit qualification will be included in eligibility income calculation. I think this is pretty much self-explanatory, but just giving an example, if your underwriter's using a bunch of overtime income, but when we try to annualize it, we're coming up with a much lower number, your credit qualifying income should never be higher than what we're coming up with, right? Ours should be always a little bit higher, if not right on. Because we should be including income that your underwriter is going to say, well, the agency won't let me count that because of this or that. So this is the worksheet itself, and it's an Excel spreadsheet, but it's pretty easy to use. You would just go in there and put in the amount. So you can see it breaks it down by pay type, whether it's hourly or salary, whether there's overtime, bonus, or other types of income. And you just do the calculation like we just talked about. The little boxes over here is which one you're going to choose to use to qualify them on. Generally, it's probably always going to be the higher, but there may be a reason why it's not the higher, like if you've documented that they're not going to continue to receive a certain type of income, then you could, example would be, well, they were in getting overtime, but now they're no longer an hourly employee, they're a salary employee, so this is what they're going to get. And there's a place for you to put comments on why you chose the income amount that you did if you need to. The whole thing is going to add everything up and come up with the total monthly income, and it's going to come up with the total annual income. Total acquisition cost is also on the form. You're going to go in there and put in there. This first box is going to basically be the sales price of your property, so whatever the sales price is. Total price of cost to construct a home on land owned by the borrower. So this would be on new construction. You are eligible to use this product to take out a construction loan. So if they've got a temporary construction loan in place, you could use this program to refinance that construction loan. It's still considered a purchase. Amount paid for the borrower for improved lot or land if owned less than 2 years before the date of initial loan application. So again, we're taking the new construction. If you do new construction loans, this is how you calculate the sales price when you're trying to put it in there to calculate your LTV. You're going to have cost to build the house, cost to, that the land costs them if they've owned it less than 2 years. If they've owned it 2 years or more, then you wouldn't put any additional cost there because it's already an asset that's aged enough. Borrower paid costs of necessary repairs to the residence that are not included in the purchase contract. Again, that's going to be any of those improvements, repairs. Let's say the house needs an air conditioner and the seller says, I'm not paying to put an air conditioner in. You would get the quote of what it's going to cost to include in that air conditioner, and you would add that in. Amount paid for cash in kind by any person to or for the benefit of the seller on behalf of the borrower. So again, we're going to use the air conditioner example. Your borrower doesn't have money for an air conditioner and grandma's going to buy the air conditioner for them. We still got to put that amount in there even though they're not paying for it. And the cost for fixtures that are not included in the sales contract. If the borrower is making you aware of the fact that they're going to go in, or they read the affidavit and they say, well, I do plan on getting the entire house repainted and getting new floors put in. Okay, get me the amount of getting the house repainted and the floors put in. I'm going to do that before I even move in. Get the cost estimates from them, whether they get them from Home Depot or the contractor, and we would just throw those in there, and that would go into your total acquisition costs. And then it's going to come up with that amount there. And we'll give you what the threshold for that is now. So sales price and acquisition limits, acquisition inclusions, and acquisition exclusions. So in our targeted areas of our state, $588,104 is the acquisition cost limit. If we look at those income limits and we look at that, I think you're pretty good. Non-targeted areas is $481,176. Again, I think you're still pretty good. Acquisition cost inclusions. The price indicated on the executed purchase contract for a proposed new or existing house, again, so that's your sales price. The price or total cost to construct a home, talked about that. The amount paid by the borrower for the unimproved lot and land if they've owned it for less than 2 years. Any necessary repairs. Amounts paid by any other persons on behalf of the borrower. And the cost for fixtures that are not included in the sales contract. Acquisition cost exclusions. Any amount for a lot that they've owned for more than 2 years. The cost for personal property not included in the contract for sale. So if they're going through their final walkthrough and they're looking at everything and there's a big TV that's left because the seller just doesn't want to move it. They don't want to move it, and so they tell you, look, I'll give you $50, or if you give me $50, I won't take this down. That's not included in the acquisition cost because it's not part of the contract. It's not a fixture. Like that TV could be removed. It's not adding to the value of the home at all. If there is personal property that is included in the sales contract, 9 times out of 10 it's going to be saying we're conveying this stuff with no value. That's fine too. We wouldn't have to go out and get an estimate of what that TV's worth or anything like that. Loan points paid by the seller, so any of the closing costs or anything that seller is paying on behalf of the borrower is not included in the acquisition cost because let's get real, it's already included in the sales price. Usual and reasonable settlement and financing costs, so any of the lender's costs, any of those things are not included in the acquisition cost. Told you what is, basically anything they're gonna do to buy the house or improve the house within the first 12 months. Recapture tax. So there are always gotchas in anything, and recapture tax is one of those things that the borrower needs to be aware is a possibility in this program. So this program has a recapture tax possibility. There are 3 triggers to recapture. Sales within the first 9 years of ownership, gain on the sales of the property, and an increase over the eligibility limit at place at the time of sale. all three of these things have to happen for that borrower to be subject to recapture tax. So if just one of them are in place, then they're not subject to it. All three. Borrowers will receive 2 disclosures that explain recapture. A recapture application disclosure is signed at the time of application. We've got that in our document set, and we'll go over that in a little bit when we talk about all this stuff. And then the recapture settlement disclosure, it is a more in-depth form. It's going to give that borrower a graph that's based on the purchase price of that home, the loan amount of that home, what the potential recapture tax could be for the 9 years. And we at AHFA will prepare that for the borrower, and we will send that to them in a packet of information when we buy the loan from the lender. In that packet is going to be that recapture application disclosure. They don't have to sign it and return it to us. We're just mailing it to them. Their first payment letters and coupons, the transfer of servicing notification, and a welcome letter. So they'll get that packet of information from us. You know, AHFA and Service Solutions are the same company. You may get questions from the borrower, hey, why am I getting this thing from Service Solutions? Who are they? Who'd you sell my loan to? And you can explain. It's the same folks that very nicely helped you get this house. And refinancing the property does not trigger recapture. So if they refi, they aren't going to be subject to recapture just because they refied the loan. It's actually selling it. Borrowers sign the disclosure at the time of application or at the time they choose to utilize the First Step program. So if you've got a borrower who's already got an application in process, they don't know that they're going to do the First Step program, you find out, hey, this house is in a target area and they do meet the income limits and this interest rate is really good, then you could go ahead and convert them over to a First Step loan, and it would just be the date that you had that change of circumstance that this disclosure would be signed. But it's important that they're made aware of it. The recapture application disclosure is posted on our Lender Online. That's the site you go to lock your loans. All Regs Lender Library, which is open and available to everyone, and will be sent to your corporate office, primary contact for incorporation, or application document. So a little bit of housekeeping here. For this program, there is a new lender agreement that's required to be signed by each of your corporate offices. We sent that to them on the 25th. We've gotten some of them back, not all of them. To be able to reserve these loans, lock them in, and start taking down your part of that $35 million, we have to have that agreement in place on when we anticipate to launch, which is Monday. So we anticipate this happening on Monday. So if you go out there to reserve a loan and you see you can't, it's because we don't have the signed agreement back from your company. So it's real important that you advocate for getting that back for us. Additionally, that agreement is a one and all agreement. There is no separate step-up agreement. So if you still want to be able to offer step-up, that new agreement still has to be signed. You don't have to offer both if your company says, look, we don't want to do the MRB program, or we don't want whatever it may be. That's, you know, their corporate policy is fine, but it's one agreement. You're not obligated to originate any loans by sending us an agreement, but you are obligated to sign it to participate in any of our programs. And if your lender does not have that new agreement into us by May 15th, then you will no longer be an approved lender to participate in our programs. And we are keeping up with everybody and letting them know, but just wanted you all to know that too. So if you go to lock a loan on Monday and you can't, that's why. So our program application and closing documents. So this is where we'll go to this packet, and it starts with the recapture application disclosure. When we're getting those new contracts in from your office, we are sending your corporate office, and some of them have requested them ahead of us even getting the signed agreement back, and we've provided them. We're sending them a packet that's got the application documents and the closing documents, so that they can go ahead and get them loaded in your origination system, so they're part of your application packages, so that they're ready to go for you. If they haven't gotten that in place and you've got one, you can email Tony, he'll send you them. You can, or Brian Hunt, you could go out to the website and get a copy of them on all regs. All of them will be available for you to get used. All of these documents can be e-signed as long as they're compliant with e-sign regulations, which means it's kind of like DocuSign or something like that, not where you send it to their phone and they do it and send it back to you. It's got to actually be able to verify that they agreed to receive documents via e-sign, and it gives the date and the time that they've done that. So as long as it complies with that, that's fine. And none of these documents have to be notarized. So no more notarization requirements on these documents, which is a huge improvement for making it easier, especially because there is a seller document that has to be signed. So the recapture application disclosure, again, letting them know that they could be subject to recapture. We'll have an informational video that you'll be able to share with your borrowers. It may not be by Monday, but we'll have it out shortly so that they can get more explanation of how recapture works. The next document is the borrower affidavit, and that document is actually a 3-page document. When we talked about all the things that they have to attest to, that's in this document. They're going to say, I'm going to occupy this property as my primary residence within 60 days of closing. They already are supposed to do that according to most of your agency guidelines, but this one is real particular. So when you're looking at your sales contracts, you want to make sure that they're taking possession of the property within 60 days of closing. They cannot have any agreement to rent that property back to the seller for any period of time, because then it becomes investment property, which is not allowed. It says that they're not going to have a separate contract to make any improvements or repairs to the property that the lender's not aware of and that isn't being included in the acquisition cost. We're not using any portion of this loan to refinance. So I think we talked about other than if it's a construction loan, which it says that in here. But an example of this would be if you've got somebody that's trying to do a rental with the option to purchase, or I can't even remember what they call those things anymore, but some of those those are hard to get through agency guidelines anyway. But this program, they wouldn't be able to do that because it could be considered a refi, especially if are already on a deed that's been created. That could cause us problems. It does say that if any of these things that they're attesting to in this affidavit are found to be untrue, there could be an acceleration of that mortgage, and that mortgage could be called due and payable. Household income eligibility, they're saying that they're told us the income that are in their household. They're not withholding any kind of income from us. And recapture, again, it's telling them that there is a tax liability that could be associated with this loan if they sell it within the first 9 years. The seller certification affidavit is the next document. This is signed by the seller. Again, it can be e-signed, and it's just saying this is the property that they're buying, and they're not paying us anything outside of that sales contract that isn't included in the sales price or total acquisition cost. The next document is the mortgagee certification. This is actually filled out by the lender. Could be anyone at the lender's office that your company decides is allowed to sign it. Could be the loan officer, processor, underwriter, operations manager. Sometimes it could be the shipper. Whatever it is, this document needs to be in the package, and it's basically the lender saying that they're attesting to all of this as well, that they're not aware of anything to the contrary. The next document is the second mortgage assistance application. That is the down payment assistance loan. It's the same as our step-up loan. We'll go over the terms. If they are choosing to utilize step-up, if they're choosing to utilize down payment assistance, they don't have to. If they don't need the down payment assistance, they don't want the down payment assistance, but they want that lower rate, they can use it. They don't have to get our DPA. Same goes for step up as well. They don't have to use our DPA program. The only have to is if you use our DPA program, you have to use our first mortgage program. So you can't, use a different type of product with it. So if they're going to apply for that, you want to have this application. The occupancy statement, which we talked about earlier, where they're telling us who's going to occupy the property. That just gives us the benefit of knowing what income limit we're going to use. Again, there's no reason for them not to be truthful on this document because we're not having to get income for a whole bunch of folks. Child support statement, this is if they've made an attempt to if you get a divorce decree over, or that there's a child support order in place, but they're not receiving it, and you're able, let's just say you couldn't even document through DHR or something that they haven't received it, they can sign an affidavit saying, I know it's owed to me, but I've just never been able to collect, and that would be fine. Income tax statement, if your borrowers are not required to file a federal tax return, then they would sign this statement saying, I'm not required to file a federal tax return. We do not have to have a copy of the tax transcript that says no record found, just this affidavit. The veteran exemption application declaration. So this is the document that the veterans sign if you're going to use the exemption for them being first-time home buyers. And they're going to mark that they have served in the military and been discharged or released under conditions other than dishonorable. You'd have this document plus their DD-214 to verify that. If they're currently in the military as a result of re-enlisting, then we'd get their form DD-4. And it can be the spouse as well. So if the veteran, let's say, is passed away, it could be the widow that uses this exemption, or if the veteran is not going to be on the loan. But you could still use this form. Conversion letter. So this letter is something that will only come into play each time we issue a new series. So there is a federal requirement that we know, because it is a first come, first serve and only a certain amount of funds available, the IRS does require, regulations require that we notify all lenders at the same time that the money is out there and ready. We anticipate we're going to send this notice tomorrow. The regulation says they don't want you all banking a bunch of loans like kind of inside ball. Like they don't want to show, or insider trading is what I wanted to say. They don't want to see that we've let a lender know before everybody else, and so they got unfair access to funds, right? So they say the application date should not be dated prior to the notice coming out from us that there's available funds. However, they do make an exception for that because, hey, you may have people who could really benefit for this program and you're going to move them over to this product. That's okay. But you have to have this conversion letter signed by the borrower stating, I already have an application in process, but this is, I requested for them to move my product over to this loan. So, you know, you're not going to get this on every loan. If we've already issued the notice of available funds and that borrower initially applied with you for just a regular FHA loan after that date, so your initial application is after that date, but then they decide that you and they talk about it and you go, well, hey, this loan would actually be really beneficial to you, and they say, yeah, let's do it. You don't have to get this conversion letter, okay? This is only if it's dated prior to that notice going out. The next time that you'll need it is when we issue a new series. We'll have to give out another notice, and then, so you only need it periodically. And if you need it and we don't have it, we'll make sure and let you know so you can get it. And that's your application document. Or step up. Yeah, they couldn't, but like if they were going to do a regular FHA with their lender and they didn't want to use our first step or step up, they couldn't use our DPA.
Okay.
Yeah, it's got to be combined. Yeah, it's got to be combined with them. Now, our first mortgage programs do not have to be combined with the others, but they do have to use one of our first mortgage programs to get our second. Okay, so closing. There's actually just one document. It just depends on what type you used on the product. And that's a rider. It's a rider to the mortgage. That one, it does have to be notarized because it's recorded with the mortgage, just like the mortgage is. And there are several different types. The first example you have here is the tax-exempt mortgage rider. This is for the conventional or the USDA loan. The FHA tax-exempt financing rider would go with an FHA loan, and the VA would go with the VA loan. We are again sending that to all your corporate offices, so that's available in your closing packages, so your closers will know how that they need to send it. It is also, we are doing trainings with some of your operations departments to ensure that your closers and your underwriters know how to do the income calculations and all of that. And if you are aware that your company needs that, just reach out to Alana Boje or Kathy James, and we'll work with them on getting something like that scheduled. All right, so we're going to go through how the process works. We're almost done. So the process, the borrower applies for a mortgage loan through an AHFA participating lender. If the mortgage loan application is dated prior to the notice of available funds, the borrower must sign a conversion letter, so we talked about that. The lender reviews the application for credit qualifying and first step program eligibility, so that's those income limits that we talked about, the acquisition cost, and whether it's in a target or non-target area. The lender reserves the application or locks the loan through Lender Online and submits the Step 1 package just like you do with Step Up. You do the rate commitment form and send in the commitment fee, and that needs to be wired within 72 hours. Again, because this money is tied up and nobody else has access to it until you cancel that reservation, we're going to watch those 72 hours pretty close because we want to make sure you're not putting a loan in there and then we never get a reservation and the money's not available for someone else. So it is important that we receive that commitment fee. At some point prior to closing the loan, it doesn't have to be within a certain period of reserving the loan or anything like that, but sometime prior to closing the loan, you all are going to submit the package 2, which there's a checklist on it. It is a little bit bigger than the one that we use for Step Up because we are actually doing an income revalidation on your behalf to make sure that they absolutely meet those income guidelines, and we're validating that they meet the acquisition cost requirement and the target and non-target and first-time home buyer, all that stuff. It's all documentation that you all should already have in place basically to underwrite the loan for credit. So it's not a whole lot of additional documentation. We'll review the package for compliance with program guidelines and issue a conditional commitment. Again, don't get it twisted. We are not credit underwriting your file. We are not issuing the credit underwriting approval. I think some lenders get confused with that. That's not what we're doing. We're just looking at it for the MRB and AHFA piece, not for the actual agency piece, okay? Loans closed in the lender's name. The lender will table fund the first and second mortgages, and the loan must close by the reservation expiration date. We don't have to have it in our hands by that reservation expiration date. It just has to close. Within 10 calendar days of closing, the lender submits the first step closed loan package to us. So we got to get the closed loan package within 10 days of closing. Reservation period and commitment fee. We charge 0.5% of the total loan amount for a 30-day reservation and 0.75 of the total loan amount for 45 days. That's just like with Step Up. Funds have to be wired to us within 72 hours. We do not charge any commitment fee for the DPA reservation. I include that for anyone who's new. Reservation extensions. Extensions must be required prior to the lock expiration. It's 0.25% for every 15 days, and you can get it for a maximum of 60 days. So from the first lock date all the way out to the very last expiration date can be up to 60 days. Maximum down payment assistance. This is just like with Step Up, but we'll go over it. Funds are reserved at the same time as the first mortgage reservation. The second mortgage loan is reserved at the same interest rate as the first mortgage. Second mortgage term is 10 years. Borrowers sign. This is a repayable loan. It's amortizing, so it's subject to TRID requirements. So you do have to send out an actual LE and CD just like normal. They sign a mortgage and a note. DPA assistance maximum is still the 4% of the sales price or $10,000. Funds may be used for down payment or closing cost assistance. And the maximum first mortgage LTV is 96.5% for FHA, 100% for VA, USDA is 100%, and the Freddie Mac HFA Advantage is 97%. You are able to exceed that 100% on VA, USDA, all of these programs. On VA, not all lenders are aware of this, but you can exceed the NOV, so the notice of value, with our down payment assistance because of the type of entity that we are. VA makes an exception for our seconds and says those are called affordable home buyer assistance that we're able to put on the loan. So you can exceed NOV value. And if your underwriter doesn't believe you, then email me and I'll send you the email directly from VA that says it. Affordable income subsidy. This is available on Step Up as well. If they're getting the conventional loan and they are at an AMI of 80 to 50.01%, they get an additional grant of 0.5% of the loan amount. And if they're at an AMI of 50 to 1%, below 50%, 50% or below, they get 1% of the loan amount. That's given as a grant. You show it on the CD where you show gifts and seller paid closing costs and all that. That goes on that part of the CD. They can use it for down payment assistance. They could use it for pay their closing costs. On this loan, just like with Step Up, the borrower is able to get anything of their prepaids back at closing if the seller's, basically paying them back for that. Appraisal, earnest money, commitment fee, those types of things, they would be able to get that cash back at closing. But they can't get any additional cash. So if they didn't pay it out up front already and are getting reimbursed for that, they couldn't get any extra money. We would have to take that money and apply it towards a principal reduction. Home buyer education requirements. At least one borrower must complete the home buyer education course prior to the loan closing. Acceptable curriculums include all HUD-approved curriculums, Freddie Mac's Homebuyer U, NeighborWorks, and the approved PMI company curriculums. Evidence of course curriculum completion certificate must be included in the closed loan package. So at least one borrower prior to closing. So fees. Talked about the commitment fee and the extension fees already. This program is, again, an IRS program. And this program is what you call a tax-exempt program. The MCC and the MRB are both. But what we're doing with the MRB program is we're actually creating bonds. And people are out there on the secondary market investing in these bonds and buying them. And any income that they earn on these bonds, because they're making an investment in an affordable housing program, is not subject to tax. So they're not, as investors, having to pay tax on the income. That's a big deal. And if the IRS sees that you're making loans to the folks that are not the intended recipients of these loans, then that whole bond issue could become taxable. And you would have a lot of investors that would not be very happy with you. So obviously we don't want to do that. Part of that is they cap not only how much the borrower can make, they also cap how much we all can make, right? They don't want to see an excessive amount of yield being earned on these loans. And so they do cap the fees that can be charged to the borrower. So the maximum origination fee charged by the lender on this loan cannot exceed 0.5%. All other fees to the lender are capped at $1,300, like underwriting, processing, admin. Any fee that's not passed on to a third party. So like your, recording costs, attorney costs, all that other stuff that's being passed along, that's not, but like your lender fees, your admin, underwriting, processing, any of those types of fees are included in that. Our commitment fee is not, okay? So, two numbers. Maximum origination fee of 0.5%. Maximum of all my other combined fees is going to be $1,300. We will look at that prior to issuing the conditional commitment to make sure we're within those limits, and that will be there. We are paying SRP on these loans. It's identical to step up. We are paying you a yield of 2.5, or a service release premium of 2.5 to the lender on government loans, and 2.25 on conventional loans. So these loans are still very profitable for the company and cover the expense of doing it. And you don't have to charge anything. Like, you don't have to charge an origination fee. Not required. But if you are going to, it just can't exceed 0.5%. We do net fund at the time of purchase a tax service fee of $80 and a funding fee of $211. Those fees are actually paid to Service Solutions, who is the servicer of the loan, and they're taken out at the time of loan funding. These fees are not included in these numbers. So if your company chooses to pass those on to the borrower, that is fine. First step program, below market rate. So these are all of our programs now. This is the full suite of what we've got. The first step program is the below market mortgage program with the 30-year first, what we just talked about. Step Up is our other program. We are keeping Step Up going, still going to have Step Up available for you all to use. Obviously, there's no first-time home buyer requirement. There's no target versus non-target. The income limit is $159,200. We're basing that income on borrower qualifying income, so the income that your underwriter uses for agency qualification is the income that we use. So there's still a market for that product, because a lot of folks still at $159,200 still need to take advantage of our down payment assistance. I always tell people, if you've got a borrower, even if they have the down payment, they're still going to need that cash to be able to make, they may need to buy a refrigerator, they may need to buy a lawnmower, they may have moving expenses, all of those things. You cannot, so like let's just say they need furniture, okay? They're moving up to a bigger house, they're going to need furniture. They've got, more kids or whatever it may be. They're going to need, they cannot go and buy furniture after our loan closes on a furniture store credit card for the percentage interest rate that we could give them on that down payment assistance second, right? Because it's just not going to happen. So it makes more sense for them to utilize our down payment assistance and keep the cash on hand. What I look at is, instead of giving you an exact rate, is the spread between market rate and what we're going to be at, and we're really aiming for at least 1%, if not more.
You're going to have some takers on that.
Yeah, sure. The other thing I will say is, if market rates start to come down, that rate's going to stay the same. So the spread may vary from time to time, but it still should be significant. But anyway, so the Step Up program is still there. It's still available. It's still a good product. It's still something that we hope folks will still participate in. And there may be issues. There may be reasons why you need to convert someone over from the First Step program to the Step Up program. Maybe you thought they were a first-time home buyer and they ended up not being for whatever reason, or their income was just to get to the approve eligible, you're going to have to go ahead and add that spouse to the mortgage, and that would throw them over this limit but not that limit, those types of things. So they're still going to be there. They're still good products. Mortgage Credit Certificate Program, that is, the Mortgage Credit Certificate Program and the First Step MRB have all the same guidelines, okay? Income and everything. We are making changes to the MCC to mirror all the requirements of First Step on Monday. So if you got folks who are still going to apply for the mortgage credit certificate, they can combine that with Step Up. They could combine that product. You don't actually have to combine with one of our mortgage loans. You can combine that with any other loan. But you cannot put an MCC on a first step because that's double dipping. They're the same product basically. So if they're getting the tax credit or instead of getting up to $2,000 per year in a tax credit, we're utilizing all of that money in one big amount, and we're reducing the interest rate, right? So we're buying down that loan is how we're taking that tax. So this is the contact information for all of us. Our mailing address, our website, a lot of information on the website. All the program guidelines and everything are now out there on all regs, so you'll be able to see everything. Our phone number, if you call that number and ask for any one of us, you'll get us. Follow us on all the social media stuff, a lot of our announcements and stuff. Do sign up on our website to receive all of our notifications. That knows available funds will be sent there. Interest rate's going to be sent there hopefully tomorrow morning. All the information is going to be there. This is Kathy James. She's our business development manager. A lot of you do know her. Alana Boje, who is our business development specialist. So she goes out and sees everybody. She is, if you know that your office needs training, you would reach out to her on this or anything else AHFA related or single family related, excuse me. CE classes for realtors. We offer a free CE class. We'll be updating it to include all of the first step program information, so that is a huge thing. If you're a lender and you want to team up with us to offer those classes, whether it's CE or not, for your realtor partners, we can definitely facilitate that, and that's the infamous Tony Lee. So he's the one who will, and his folks will be issuing your conditional commitment.